Hi, this is Real Turkey. My name is Guldem Atabay, and I'm the host of the program for this part. And my occasional guest is Mr. Atilla Yesilada, who's a well-known economist in Turkey. Hi, Atilla.
Hello, Guldem. Great to be here again.
Thank you. It's my pleasure. Let's just go over the economic data that we've seen this week. We have seen the PMI recovering fastly, but not really above the 50 benchmark level for Turkey. We have seen the June inflation coming almost flat, bringing the year-on-year inflation from above 18% to around 15.7%. And in parallel, the expectations for a rate cut has just intensified, and people are talking about the central bank's monetary policy meeting will be delivering 100 basis points rate cuts for the markets. Is that really possible? Is that really necessary? And is there a possibility that we'll be going to seeing single digits inflation that will remain as single digits by the end of the year? So what's your take on this issue?
Well, I think we have said in the previous episode that summer is going to be easy for Turkish economy and there would be signs of a recovery, but they will not be sustained. Starting with the PMI, as well as a lesser-known composite PMI called SAMEKS, they both improved, but nevertheless, they remain. The headline remains below 50, which means both the industry, and services sectors are still shrinking. It's just that the pace of the shrinkage has slowed down. I looked at the forward-looking sub-items such as orders and intentions to hire. They are really not that good. And to connect to the next question, those who participated in the survey claim that they have been able to pass their input price increases to the next level or to the consumers, which is good for them, bad for the Turkish consumer. So I think over the summer, with some recovery in the EU economy, Turkish manufacturing sector will improve, but there is really no hope for construction and other automotive, retail, etc., etc. As far as inflation, there was obviously huge seasonality and base effects because of last August, really devastating currency shock. When we look beyond that, we don't see much of an improvement in inflation indicators. And whatever there is driven by the fact that there is no domestic demand. I mean, there is no purchasing power left in this country. So, yeah, inflation, will decline to single digits at some point in autumn, then will pick up again. But if we look beyond the sinus wave, like short-term movements of inflation, I don't think there is any real effort to fight it. I mean, we still have a president who believes that higher interest rates lead to higher inflation, which in my view is the worst way to anchor low inflation expectations. Coming to the central bank, first of all, I don't think central bank makes monetary policy in Turkey. It's Mr. Berat Albayrak or Mr. Erdogan. And my assessment of what Mr. Berat Albayrak wants is that he wants lower rates, just like his boss, as soon as possible. Today's American non-farm payrolls data wasn't very conclusive about Fed intentions, but I'm fairly sure if Fed cuts rates at the next FOMC meeting, it won't be the beginning of an easing cycle. There is simply no case, to go back to the QE period. So it remains extremely hazardous for the central bank to cut rates. Also, as we have expressed in our episode 3, the previous one, the S-400s issue has not gone away. It could still unfold in a manner that would cause currency shocks, which immediately pass through to the inflation. But my view is, along the consensus of the market, yes, as long as we don't have a sudden flare-up in the currency, central bank will cut 100 or 400 basis points. And why shouldn't it? I mean, I read respected analysts. These people expect up to 900 basis point rate cuts within the next 12 months. So central bank is being enabled, encouraged to cut rates, and I'm sure it will give the markets what it wants.
So how will see the Turkish lira reacting to it, do you think?
Um, I One thing about Al Bayrak said is that we will have current account surpluses, if not in May, then in June.
Definitely in June, he said. Yeah.
This is true but trivial. We will have current account surpluses throughout the summer. But this is largely because, as I've said, no one is importing. No one is importing raw materials, intermediate goods, or capital goods. So, if the solution to obesity is a hunger strike, then yeah, we do have a current account surplus. But from the viewpoint of the currency, it underpins the current dollar TL exchange rate, as well as my understanding that most of the foreign investors are willing to forget the S-400 issue until a very specific and imminent threat comes from the United States. So I am fairly comfortable about the exchange rates fluctuating in a very narrow range. But I am extremely alarmed by the fact that Turkish depositors continue to accumulate FX deposits. Turkish corporates are selling, but it's not clear whether that means they have increased confidence in the economic management in the economy, or they are simply running down their cash surpluses because EBITDA is going down. They simply can't generate enough cash. So in the short term, constructive on TL. Anything beyond August, I really don't think we have solved our weak currency problem.
Looking beyond this S-400 issue, just putting this aside, because we don't really know how it's going to turn out, although we feel how it's going to be turning out. But so the tendency, the confidence indices are recovering. We are seeing the PMI recovering. Do you think Turkey has seen the bottom of its contraction cycle, looking at the first quarter and the second quarters and the start of the third quarter's performance? Or if the recovery or if the bottom is reached, what's the growth potential for the second half of the year or for next year, obviously? So where we're really heading to? What we've seen last week is looking at the PMI indices. Among the indices, this demand coming from external new orders, or this is what we call exports, has turned positive above 50 benchmark. So is there a strong export demand to be combined with a little recovery from domestic demand down the line throughout the year, do you think? Or it's just a phase that we're going through and it's going to fade out by the fourth quarter of this year?
I think Turkish economy will bounce around the floor for the foreseeable future. As the most reliable and up-to-date preliminary indicator of Turkish economic growth, I look at credit momentum, which has a very strong correlation with GDP growth 2 quarters hence or in the future. And credit momentum has turned negative again. Turkish private banks have not lent in real terms or in nominal terms since the beginning of the year. Consumer confidence may be increasing, but consumer credit is not increasing. And without substantial increase in consumer loans and credit card expenditures, demand for housing, automotive, furnitures, etc., shall remain weak. There is another problem which the government denies, the banking regulator BRSA denies, and banks are happy to extend and pretend, which is that we have not solved our corporate debt problem. Simply because there is no cash flow to pay the existing debt. All the upcoming loans are being restructured. We have seen a new spike in Chapter 11 applications, that is bankruptcy protection applications, and profitability is significantly down. So the banking sector is simply unable to sustain growth, even if it were to start. And the government really, never mind the reforms which would open up the supply side, the government hasn't really addressed the key issue of what the economy would do if they were to withdraw, even gradually, the fiscal stimulus they have unleashed on the economy in the first 5 months of the year. I just read the Bloomberg Economist survey. The consensus is the budget deficit to GDP ratio to rise to 3.6% at the end of the year and not decline below 3% for years to come, which is no big deal for other countries, but we have an extremely shallow financial system which cannot finance such borrowing. So either we'll have to rely on foreign borrowing or we'll have to cut expenditures, and any cut in expenditures is going to hit this economy like a hammer. Monetary policy, even if we cut rates by 400 basis points, is not going to help because banks are no longer borrowing through the open markets operations window. I mean, the share of central bank funding in bank operations or bank balance sheets is down to like 2%. Mm-hmm. It wouldn't suffice an easing cycle by the central bank. It would require something like a QE, flushing or flooding the money markets with, hard cash, and that would lead to further dollarization. No FDI, no one trusts Erdogan/Berat Albayrak administration. So as far as I'm concerned, once the summer relief or summer pickup ends as tourists leave in September, October, the recession will resume again. And Turkey's growth potential, in my view, so the cruising altitude has declined below 3% because excluding land and buildings, Turkish private sector has not invested in machinery or software or equipment, which means even if there is demand, they cannot produce efficiently or compete in new goods and services areas abroad. So, I don't anticipate a crisis or anything like that. But the outlook is, modest to say the best. And until we have significant reforms and a change in mentality in Ankara, the Turkish economy will never go back to its heydays of, say, 2012 or 2011.
You have said that I don't expect a Fed easing cycle apart from maybe a one-off cut in July, at the end of July. And you're saying that Turkey is going to grow like anorexically in the years to come. So do you think, room for development? So we have the next 5-year development plan within the hands of our president, but we haven't seen any reforms to support productivity in Turkey. So almost no growth. Is there room for development for the Turkish economy in the near future then?
Well, I haven't given up hope, but I know one thing. It's not my personal viewpoint. It's the viewpoint of most of the experts I consulted. People have completely lost confidence in Berat Albayrak. And to a certain extent, though it's not his fault, in Mr. Çetinkaya, who is the central bank governor, to signal a strong commitment to reform. Erdogan must replace these people and bring in capable managers. Finally, I think the calls are increasing that the corporate debt problem, which is being transferred to bank balance sheets, cannot be resolved in the absence of significant funding. I'm talking about $50 billion or more, which only IMF can provide. So until all of these elements coalesce together, gel together, I will not be changing my opinion. Erdogan usually does what he needs to do when he realizes that the current path of policy is not helping the economy or is damaging the economy. But as we heard from Mr. Berat Albayrak today, who remains his top advisor, Berat Albayrak is really doing a good snow job of convincing Mr. Erdogan that everything is hanky-dory and this very transient summer improvement is going to translate into rebalancing and a new growth episode. So I wish them luck, but I don't believe it.
Thank you very much, Atilla, for today's contributions. Please keep contact with us for the coming episodes. Take care. Bye-bye.